Do you realize that life insurance contracts are unilateral contracts, meaning we as the policy owners have one obligation and all of the other obligations land on the insurance company? And what is that one obligation? Well, it's paying the premium on our policy, making sure it gets paid to maintain that death benefit. But what happens if you can't pay your insurance premium? What are your options? Hi, I'm Olivia Kirk.
I'm Tim Yurek. We're from Tier 1 Capital, and we're here to show you how to regain control of your money.
When it comes to life insurance contracts, especially a whole life insurance contract, you're kind of entering a commitment here. It's a contract between you and the insurance company, and you're saying on your end, hey, I'm going to pay this premium. But what happens if you're not able to pay it? What if cash flow's tight? What if you don't have access to the money? What options do you have as a policy owner to keep that policy in force?
And that's a great point because, life has a tendency to throw stuff at us. And sometimes when the premium is due, we may not have the cash available in order to pay the premium. So what are our options? And again, a lot of times these questions come up before people are going to buy an insurance policy. And when you get into this cash flow pinch at that time, the key is, how much equity do you have in the policy?
Exactly. So with a term policy, you're not going to have any equity. So if that premium doesn't get paid on an annual, monthly, quarterly, or semi-annual basis, you have the option to change the rate at which the premium is paid to better suit your cash flow. Right. But other than that, if you don't pay the premium within that, I believe 30 or 60 days in most cases, the policy is going to lapse and you won't have coverage anymore.
Yeah, and that could be an issue for your family. But the other issue is, if there's a permanent life insurance policy, a whole life policy, the question becomes, how much equity do you have? You see, in the early years, there's very little equity in a whole life policy. And sometimes the way we structure policies, we structure the policy for maximum equity in the early years. So there's a good possibility that you may have enough equity in the policy to actually borrow money against the cash value to pay the premiums prospectively.
Yeah, or at least a portion of it, right?
Exactly. But the key is you have that option, assuming you have cash. Now, if you just buy a regular whole life policy with no extra money put in through this paid up additions rider, down the road, every year, the way these policies are structured, you'll have more and more equity or cash value in the policy. And if this happens, meaning that you have a cash flow issue and can't pay the premiums in the later years, let's say after year 4, 5, 6, there should be enough equity in the policy to pay a year or 2 or 3 in advance. So that could definitely bail you out if you run into a cash flow problem. I'll give you an example. We have a client who, when we met him, he was 67 years old. And his dad had purchased a policy on him when he was 13. And unfortunately, his dad passed away when he was 16. So they only paid 3 years of premium into the policy. And when he met me, he said, hey, the reason I'm calling you is because I have this policy that my dad bought for me when I was 13. He died 3 years later. We never made another premium payment on that policy. And I'm still getting information from the insurance company. Is that policy even still active? I said, well, send me the notifications you had gotten. And sure enough, they were premium notifications, meaning that the policy was still in effect. So ultimately, we had him get an in-force ledger, which gave him the ability to analyze exactly where the policy was at that stage in his life. And sure enough, there was a loan of $7,500 against the policy. So he was in a very good financial position when he was in his 60s, and he had the cash to put back into the policy. And when he did, the type of policy his dad had purchased for him was life paid up at age 65. So he paid back all those loans, and now he's got a completely paid up policy. And the death benefit, by the way, was now $12,000 when it was originally $5,000 when he was 13 years old.
That's pretty cool.
Yeah, so it was really a nice situation. And oh, by the way, he's still earning dividends and interest on that policy, on the cash value. So that means the cash value grows, and as the cash value grows, the death benefit grows. So he's getting a really nice benefit, and literally out of pocket, his parents, his dad paid 3 years of premiums, and he had to obviously pay the $7,500 to pay back the loan, but now he's in a really good financial situation as it relates to that policy.
Right. So in most cases, when people are in this situation, they don't want the policy to lapse, or else they wouldn't be calling us, questioning what can I do instead of letting this policy lapse and I can't pay my premium. So we have the option of a policy loan if you have that equity available. If there's equity available, you will also have the ability to surrender dividends or cash value in order to pay that premium. That's going to have more of an impact, right? So when we take a policy loan, it reduces the cash value availability and the death benefit dollar for dollar. When we do a surrender of dividends, it's going to have more of an impact on the cash value and the death benefit for that policy. And it's also going to impact your policy growth going forward, right? Because we're not earning dividends on the dividends, for example. The other option we have would be to reduce the policy, right? So let's say you're in a cash flow pinch now, you don't see yourself coming out of it, and instead of $1,000 a month, you're able to afford $500 a month. You may be able to reduce the face amount or the amount of death benefit you're paying for on a monthly basis and fund that amount of death benefit instead.
Yeah, that's, again, you have options, and that's the key. Understand that the insurance company puts in a lot of safeguards to guarantee that you won't lose the policy for something that's beyond your control.
Exactly. And then I think the last option I would say is a reduced paid up policy, right? So let's say you've had the policy for 30 years, there's a decent amount of cash value accumulated in the policy, and you want to retire, you don't want to pay those premiums anymore. Although it's not recommended, if you want to, you have the option to do a reduced paid up policy where it freezes the policy, the amount of cash value in the policy buys up a certain amount of death benefit for you, and then it'll just continue to grow and you don't have to worry about premiums anymore. It's kind of like a limited pay policy, but you start off planning to pay for X amount of time and then you cut it short once you reach that age of desired cutoff.
Yeah, and again, you have that option. And what the reduced paid up does is it takes the existing cash value and says, if with that cash value, how much of a paid up policy can I have? You might have had a $500,000 death benefit, but maybe with the reduced paid up, now you have a $300,000 death benefit, but no more premiums going forward. And a lot of times people like that option, especially in retirement if they're living on a fixed income.
Right, and you're not subjecting yourself to any taxation with the surrender of the policy. All you're doing is reducing the amount of death benefit you have, but in turn, you no longer have the premium obligation.
Yeah, and the key is when it's reduced paid up, you continue to earn dividends and interest on that remaining smaller policy.
Exactly. So, I mean, the last scenario that we'll look at really is the surrender of the policy, right? So if you don't want to keep the policy anymore, you're able to surrender it. You'll get all of your premiums you paid back on a tax-free basis. Anything over the premiums paid would be taxable as income in the year of surrender. If you're in a position where you can't afford your premiums, your best bet is going to be to reach out to your insurance agent or your insurance company to see what specific options you have for your policy. If you like this video, check out these two. We picked them out special for you.
Thanks so much for watching our video. And remember, it's not how much money you make.
It's how much money you keep that really matters. We'll see you in the next one.